Thank you, everybody, for joining us today. We're going to have a start of our new series that we're doing. It's kind of a more of a podcast style where we get to interview some investors in the space, some operators we work with, and get to ask them some questions I've that have been submitted to me, as well as kind of general questions, and get us talking. Today, we're going to be talking about due diligence in operators' funds and promissory notes. And I'm joined by our Chief Investment Officer, Heather, who's on an iPhone. And then Craig from Money Ripples. If you guys want to do a little intro about yourself, tell everybody here about you, and then we'll kick this thing off.
Yeah, I can go first. Like Kate said, my name's Heather. I am the CIO for Central Lending, and my background is really just managing debt funds and investor relations. I have quite a background in underwriting, servicing loans, but I would say my superpower is really dealing with investors and answering questions and just kind of helping them navigate through alternative investment options that are out there. So thanks for having me.
Of course, it's pretty. Got to have your boss on. Craig, tell us a little bit about yourself.
Yeah, thanks, Kade, and good to see you and Heather as always. I appreciate the invite to the podcast. My name is Craig Feldmeier. I am an investment and money coach with Money Ripples. We have a podcast, so check us out, run by our leader Chris Miles. I've been in the money and investing space really since I graduated college, all the way back in 2008. So I worked for one of the big banks on Wall Street in the ultra high net worth private bank space for about 10 years, and then moved into the alternative asset space, in the cash flow space, about 4 or 5 years ago. So I'm all in on all things alternative assets, cash flow based investing. And then, on top of all that, what is the key? Due diligence. I know that's going to be a big focus of the call today. Not only with alternatives, but with any investment, right? Critical to do your due diligence. And I'm excited about the conversation today, Kade.
Awesome, Craig. Just curious question. I have to ask. I think I've asked you this before, but since you've worked on traditional markets, and then now you're in alternative assets, do you have a favorite? I think that's kind of
Cash flow
an
all
easy
day,
question, but I wanted to ask.
Yeah, I love cash flow investing. I think there's a place in every portfolio for lots of different types of assets. And what I love about being a coach, right, as opposed to a traditional advisor, is there's no one size fits all portfolio, right? It's very goals based. It's what are Kate's investing goals? What are Heather's goals? What are Craig's goals? And based off of what your goals are, that's how we kind of back into what is the perfect asset allocation.
Gotcha. So I got a few questions we're going to roll through, and then I'll kind of be a moderator, and then I'll ask questions of you two. You guys can bounce each other off and just get some conversation going. So, Craig, from your perspective, why is due diligence even more critical in alternative investments than in traditional public markets, if it is? But why is it more critical in this space for investors to really dive into the due diligence side of things?
Fantastic question, Kade. And I would say it is more critical on the private space than, say, like the public equity market. Like, you're just going to go buy Apple stock, right? Versus if you're going to do an alternative investment. And the big theme is the concept of liquidity, right? So in a typical private investment, your funds are going to be locked up for a period of time, right? And that's going to depend on a lot of different factors, but at least for a few months at a minimum. Versus on the public side, you buy a stock, you like it, you ride the wave, and if you need to redeploy your capital, you hit two buttons. In 24 hours, you have cash in your hand, right? Not so on the alternative market. You need to do a little bit more research because your funds are going to be tied up for a specific period of time.
Yeah, that's with operators it's not that immediate return you see in the traditional markets. Heather, what are your thoughts on traditional versus alternative asset due diligence?
Yeah, I mean, I'm not here to tell everybody to pull everything out of the traditional markets and stick everything in alternatives by any means. I mean, for transparency, I don't give financial advice either, but I do think that alternatives have a place in people's portfolios. I think they provide some very good returns. Obviously, and we're going to talk more about this. You need to do your due diligence. But I also think that a lot of people don't understand that private options, alternative investments, whatever you want to call it, are not necessarily as always liquid as your more traditional resources. And so, one of the things I talk a lot with people about, you'll get them calling in, and you've had these calls, Kate, I'm sure. Well, they were on a podcast and they saw this on a webinar, and they can get, high double digit returns, and they don't really even know what they're trying to accomplish yet, right? They just kind of get this, hype up that they can get these higher returns. And so, one of the things I tell people do is to step back and first understand what you're trying to accomplish, what kind of dollars you're trying to invest, and then start to perform your due diligence. And I think at least I can tell you that the clients that we get that are part of the Money Ripples community are much more educated and ask really good questions and have probably a better understanding of what they're trying to accomplish before they go into these investments, because I think there's a lot of things to take into consideration before actually making an investment.
Couldn't agree more. Yeah, Craig does a good job with those guys over there. They answer good questions. You're gonna
I
hop on a
appreciate
call
that
with us.
feedback.
You better have your stuff together.
We do a lot of education. That's for sure.
But so kind of diving and they asking the right question, kind of the most important to avoid this. But you guys have been in the industry for a long time. What is kind of the biggest mistake that you see investors who are used to typical markets kind of diving into the private space, whether it be, promissory notes or, in the fund space? What's a big kind of rookie mistake that you see people do too often?
I love this question.
I do too. You go first, Craig.
Okay, I'll go first. From my perspective, people get, especially in the alternative space, but also in the public market space as well, people get into investments without realizing what the investment is designed to do, right? And I'd say the biggest mismatch I see is people getting into private deals thinking that the deal is designed to yield cash flow, when in reality it's a growth play, right? This was really common a few years ago in the multi-family syndication space, right? I mean, we kind of saw that wave of deals kind of when rates were cut. And, in a lot of these pro formas, a lot of the presentations, the operators are talking about, a 2x on exit deal with, a 10% pref paid quarterly, right? And what a lot of investors didn't realize is if there's any headwinds in that deal, and in a multifamily syndication space, expect headwinds, the first thing that's going to get cut as a limited investor is going to be the pref, right? And so a lot of people, were expecting consistent cash flow, and that's not the reality of a lot of how these deals are designed, right? Versus if you get into a deal, say with the central lending fixed income fund, that is designed to pay investors every single month, right? So that is for cash flow. So I think it's really critical that investors identify where they're trying to go, and then make sure that they're picking the right investment that is designed to efficiently get them from point A to point B.
Yeah, I love that. I think my answer was probably going to be part of that. I also think chasing yield is a big issue. I think it's gotten better. But when everybody was doing really well 3-4 years ago and there was no headwinds or disruption, there was a lot of yield chasing, and I tell people this all the time. I think we actually have one investor that got on stage last year and was like, Heather told me not to chase yield, and I did it anyways, and I ended up having to foreclose. So sometimes if it's too good to be true, you might dive a little deeper into the investment. And I like I said, I do think the sentiment has changed. I think people now are looking for more just consistent returns versus the home runs. There's nothing wrong with the home runs. But I think, to your point, Craig, these syndication deals, a lot of people, I'm going to 2x my money, and they don't realize that the exit isn't for 4 to 5 years either, and so they're potentially not going to be realizing those returns until somewhere down the line. And then, to your point, a lot of those projects, the whole model was relying on financing, and we all know that rates went up. And so really understanding who you're working with, I think, is a big mistake as well. I think people kind of, take people at their word and don't do their due diligence and understand who the operator is. What's their experience? Have they went through any headwinds? How did they get out of a bad deal that didn't go as planned? So I think the kind of the second component to mine, not just chasing yields, is really not understanding who you're investing with. I think who you're investing with is probably more important than what you're investing in, at least in my opinion.
100%. That is the key question for success in any private investment. The first question you want to ask is, who am I investing with? And then the second question is, what do they do, right, to make money for their investors? And most people will flip that script. And that's definitely a huge component to being successful in this space long term.
Yeah, and I think that kind of segues perfectly into what my next question for you guys was going to be is, we've had a few of these where we talk about this. It's kind of the same sentiment every time, right? Do your due diligence. But at the end of the day, folks are looking to invest to get a return on their capital, right? So for you, Heather, why do you say when you evaluate an investment, start with the sponsor instead of the projected return or even the fixed return? If it's a fixed return, for example, why are we starting with the sponsor if, this is our retirement capital? And if it's an equity return, shouldn't that play into their due diligence? Because they are investing, they're not investing capital for the fun of it. They want to make some gains on this retirement capital or their private capital. So why do you always say start with the sponsor rather than the projected returns, other than just doing your due diligence?
Yeah, well, I think it's easy to create a nice little pretty PDF that looks, great in theory and, potential returns. But I think it's important to understand the operator that's actually going to pull that project off, right? Like, what is their background? I've heard of deals go sideways where, an operator was originally in the residential market space and now they're doing commercial and self-storage, and, they're trying to be everything for everybody. I think finding an operator that really specializes and stays in their lane and has a track record. I think a track record's really important, and I think you should be asking that operator, hey, I'd like to see your track record, and if they're not willing to provide that, that's probably a huge red flag for me. And I also, one of the things that I empower people to is know what is a no for you. Like, people don't talk about that. Okay, well, if all these things check off, that's great. But, what are the red flags that are hard passes for you that you're not going to move forward with the investment? So I say to really do due diligence on the sponsor or the operator, whatever you want to call them, so that you know who you're doing business with, because this is real estate and any investment has risk. It doesn't matter whether you're in the stock market or the alternative space. If things don't go as planned, none of us have a crystal ball, right? You can't time the market. I want to know that the operator I'm investing with has some history, and has a backup plan, and then also understand who their staff is. There's also the concern with a single point of failure. Is it one person that's pulling all the levers, and what happens if they get hit by a bus? Do they have a succession plan that, this investment would still continue and thrive and at least wind down, and I would get my money back. So I think, making sure that there's capital preservation at the top of their importance would be something I would definitely look for too. It's great that you can earn me good returns, but I want to know at the end of the day, I'm not going to lose my money.
Good point. That's kind of important. So
Yeah.
Craig, when you're talking to these folks, kind of what Heather said, and it's a common question I get, so maybe you could address this, is like when everybody says, looking into their track record. Obviously that means more than just like their years in business. What do you look for? What do you coach for to look for in these, sponsors or operators' track record more than just, when they were founded or when they created the LLC?
Yeah, such a good question, Kade. It's smart to do. Let's get our old friend Google, right? When you're looking for new operators, put the people, the C-level people's names into Google and see what pops up. You'd be surprised at how much information is online, right? Versus what people will tell you in a pitch deck. Because it's easy to form an LLC, form an investment group, and raise capital. What you don't know is what's that person's or that group of people's track record over the past 10 to 15 years, right? Have they raised capital for funds that have gone bankrupt? Have they ever lost investors' money? Really important to, I'd say, trace somebody's history versus what their kind of latest deal looks like. Because it's easy to rebrand, to rename companies. I've seen this over and over. So definitely look at whoever the CEO is, the CIO, what have they done in a prior life? And I'd say, the online footprint is, it's not really a luxury. It's kind of a necessity at this point, right? So if somebody doesn't have a long track record that you can trace, look at LinkedIn, right? Reach out to other people who have done deals with them, for 5, 10, 15 years. Those are all really good cursory things to do to make sure you know who you're investing with. Because I'd say for me and our community at Money Ripples, it's honestly less about performance. I mean, we expect performance, right? But it's less about performance and it's more about a core values match. So what you and Heather and your team do so well is handle client questions, provide clients, data and webinars. We had a great call with you guys a few months ago with Drew, who's Central Lending's CEO, and we went through your audited financial statements, right? Talk about due diligence. So I'd say, and your guys' willingness to go to that level of detail gives our investors a lot of comfort and confidence, right? That they're investing with the right people. And should things go wrong, we're very confident that you guys will have a plan to right the ship, right? And so I think getting comfortable to that level of detail is a necessity, right? For any alternative investment that somebody's thinking to go into.
You're too kind. I was going to play a sound effect. You're too kind for that. I appreciate that.
It's true. I speak the truth, man. Yeah, no doubt.
Get nervous on these when they start talking about, like the team members. And I'm like, yeah, I hope that this is going to be good. It is live. I can't shut this down.
No editing, Kade.
No editing.
And I'm not paid to say these things either. I want to make that very crystal clear. This is unsolicited advice or unsolicited discussion from my perspective.
I appreciate it.
I was just going to say, I've had clients also ask for references.
Yes.
And I think as an operator, the best thing you can do is not just give somebody a reference that's going to give you a raving review. Of course, we love that. But, the ones that I actually send people to that ask for references are people that are going to tell them the good and the challenging times, right? None of these investments are always perfect every time. But I think at the end of the day, what people want to know, and I actually just talked to one of your clients this morning, Craig, and I said, what I can assure you is I will pick up the phone. If you ever have concerns or questions, I can promise you that you will be able to get a hold of myself or Kade. And I think that's another big one too, is really just asking those questions up front, like what are the expectations? How often do you guys report? I mean, I've had people tell me they've invested with an alternative and they don't hear from them for a year, which
Wild.
isn't always uncommon. Like with a syndication, there's not a lot to report on, but if you don't know that ahead of time and you're expecting communication on a monthly or quarterly basis and you're not getting that, that's probably going to be a problem and may not be a good fit for you. So I think really understanding who the operator is and really how they function before making it and then determining whether that's a good fit for you or not, might save you some headache as well.
Yeah, and I think a common question that I don't think gets asked enough from people who are investing in these funds and what that looks like is, how is the operator making money? Like,
Yeah, that's a good one.
what is the purpose of this? I mean, if we're paying out, investor earnings, where's your cut? Is it off of the management fee? Is this all you do? You're just a fund manager? Is there a business behind this fund? Where's the operator making their money? And my opinion is it with my own dollars, if the operator can't explain it, in a quick phone call on how they're making money, it's always red flags for me, and kind of thrown aback. I get nervous when it's not a simple explanation. Obviously, there's very complex strategies for people to make money in this space, but it can always be boiled down to a very simple strategy on how they're, increasing revenue for their company as well as for their investors, because it's a mutual partnership, right? But I think what that kind of speaks to as well is, Craig, how important, obviously, years of market kind of touches on this, but sometimes the years are really good. How important is, market downturn? Does that play into your due diligence? Like, have they lived through a full deal cycle? What does that look like from, like syndications perspective, as well as, lending funds, what that looks like for you guys when you're doing due diligence?
Yeah, I love that question too. And I want to piggyback off of your last point as well. So you were saying, not only do we want to ask our investment operators who are potentially interested in doing business with how they make money, we want to logically make sure we understand how the yield is generated and how you guys can pay X percent, right? So say a fund operator or fund manager is going to say, we're going to pay our passive investors 10% annual returns, right? Not only should you know how the operator makes money, you should get to the level of detail where that 10% makes sense, right? Because I've talked to people who said, hey, Craig, I was on the phone with this new prospective operator, and they're saying they can pay me 20% annual returns, right? And I never say, yes or no, right? Because that's not my job.
Awesome.
My job is to say, let's dig deeper, right? Let's figure out how can we get comfortable around the operator making 20%. That's a huge number, right? Is this an industry that I'm not familiar with? Do they have massive margins? If so, and we can get comfortable with it, maybe we throw some money and see how it goes. But if it seems too good to be true, it typically is, right? And most operators that play in similar asset classes are going to pay somewhat of a ballpark similar return. And so if there's an outlier, there's probably a reason why. So I just want to preface to kind of continue on from your earlier point. We want to know how they make money, but we also want to say, is what they are paying, does it make sense, right? And can we understand how they make those payments? So really, really important.
Folks shouldn't be uncomfortable asking that.
Ask away. There are no stupid questions when it comes to investments. If you don't understand terminology, because oftentimes, the three of us, this is what we do all day long, right? And so we'll throw around terms that make sense to us, but don't make sense to some of our newer investors. So, ask a lot of questions when it comes to understanding these deals.
Yeah,
I also
trick as well.
would add, I would also add too that the operators, the way that they're compensated should be in alignment with the way that the investors paid, right? Meaning they're not taking a big fat fee up front and then anything that's left over the investor gets, right? Like, for example, our equity member positions that we do pay what's called a preferred rate, and that's 9%. we become profitable because we get a split profit after we hit that hurdle rate, right? And it's a 75-25 split. That encourages and motivates us to make sure that that fund's, targeting higher returns, because that's how we're a for-profit company. But that would be my additional comment on that, is just, make sure that the way that that operator is being paid is in alignment with you getting the returns that you're looking for, I guess.
Agreed. I always say a trick you can do is if they're throwing around terms that are like big and complex and you're not really understanding them, it's I struggle to find the word. Is I often say legalese. Like they use big terms, kind of gets. If you know what they're talking about, it's okay to ask and have them define what they're speaking about. What does that mean? Even if test their knowledge, test the operator. Are they just throwing out big terms to seem very established, or is this a solid operator who knows what he's talking about? Because I find myself, like Craig said, I get kind of in the flow of things in a conversation. I'm throwing out terms that if you haven't been in the private lending world, that doesn't really make sense. So it's okay to ask, and it's okay to pretend to not know everything, and ask and really dig into the operator you're speaking with and have them explain what their strategy is, what they're meaning, and even those little terms that you see and throughout their documentation. What's this say? Okay. Sorry, I lost my questions. Let me pull them back up. Pause. So this kind of touches into this point before we go into the actual investments that I think, Heather experienced the space, and Craig, having, you deal with probably multiple operators, with your clients. All of these questions kind of touched on transparency. The response you want is based on transparency from the operator. But what does that actually look like in practice for you, Craig? What does that mean if you have a client that goes to an investment and they do their initial call? How are you seeing that this operator is truly transparent with what they're providing? What are they providing? What are they talking about? What information are they sharing? Kind of a loaded question, but
yeah, no, it's a great question. And so when when we're doing our own internal due diligence at Money Ripples, when we decide, is this somebody we want to potentially partner with our clients, we'll often speak to people for years before we'll make an introduction. Chris and I have known Heather for, a long time. And so as with anything in life, relationships and reputation, I'd say, are paramount. So when you know somebody's core values, when you know their track record, it's a no-brainer. When it's somebody new, I think there's not a one-size-fits-all answer. You have to use your own intuition, and then you have to get really technical, right? So, I like to see, at least on the fund side, I like to see audited financial statements, which is not super, super common in the private space. Audited financials they're not a performance report. What they are is an independent third-party verification that the P&L is accurate and that the assets and the liabilities are real. Right. So just to get that level of comfort, I think, is really critical, especially on the fund side. Right. When an operator is willing to pay for a third party auditor to do an intense review on an annual basis, it says to me, that this company really has their processes and procedures in a really good place. And so that's kind of an additional level of guidance that I give into our clients. If it's a fund, let's make sure they have third-party audited financials. If they don't, I don't want to say it's a complete disqualifier, but then we have to continue to do some more digging, right? And then I think it's what are the C-level people's histories, right? Have they had any deals that have gone bad? And let's talk to some clients who have been with these people for a number of years, right? I think, people are willing to share a lot on private conversations. So it's really kind of, what's the track record? What's the industry they're in? Do they share our core values? And if it's a newer operator, I don't want to say don't invest, but be very cautious, right? You got to start somewhere. But if we have a 25-year-old who is, raising capital to run his own fund, and he's, doesn't have any mentorship in place, that to me would be cause for concern, because markets are volatile, right? I started my career right around the financial crisis. I don't even know if you remember that, Kade, back in 2007, 2008. I'm sure Heather does. But the market was absolutely insane. I was on actually a credit default swap valuation desk, and my bosses didn't even know how to value the securities, right? And this is at a really prestigious firm. And so I think, I say that where it's important to invest with people who have a long track record, who have a little gray hair, I think, and who have dealt with a lot of different market cycles.
But a 25-year-old raising capital for somebody else's fund that's good, right? That guy's probably awesome, super great with clients.
100%. Green flag.
Exactly. Yeah, I got nervous there.
Kade was starting to sweat.
That was funny. I was sitting here kind of just like.
Love the sound effects, Dave.
I gotta figure out a way to cue it in there naturally. No, but I think that's a great point. And having deals like that super long track record is important. Trust me, I love working with Andrew and Heather because I don't have the experience. If I started my own fund, I agree with you. I would be very speculative. But having an operator with gray hair and definitely some track record, and having some markets change all the time. And
are you saying I have gray hair
and how they pay out their investors?
Rude, Kade.
No, never. I would never say that.
I'm just kidding.
What? No.
I said, are you calling me old and telling me I have gray hair?
And Craig, just for the record, I do remember the 2008 crisis. It was very hard on my parents. I was in kindergarten. So
oh
I do remember it.
It's true, though. It's interesting that you bring it up, just the challenge with your own family, right? Because I remember, I think I had probably $1,000 in my 401k at that point. I was just getting started. And I remember some of the partners I was working for in panic because their 401ks literally within the span of months were down 50%. And who knew what was going to happen at that point?
That's crazy.
Yeah. So Heather, from
I think one of the conversations. Oh, go ahead. I'm sorry.
You're good. No, you're fine. Go ahead. There's a slight delay. We're going to have to work out. We got to get a studio or something to have everybody fly in. But go ahead.
I was just going to say one of the things that I hear a lot from Craig and Chris's clients that I love this question and I don't get asked it enough is, what is the risk? What could happen? And that's a conversation that I don't, like I said, you guys must train your clients very well, Craig, because a lot of them will ask that. And I think it's a valid question, right? Like, again, there's risk in any investment you do, but having that hard conversation with an operator, like, hey, what is the risk? Could I lose some of my capital? Could I lose cash flow? How is my investment secured? What are the assets in the fund? Another one is, what's the capital stack look like? If we were to wind a fund down, who gets paid first? And so those are awkward conversations to have, but I think they're really valid, especially, let's say potentially, Craig sends us a client that is trying to create cash flow. They've sold their business, they're trying to live off of their income and have their money work for them. We are a debt fund. It would be pretty unlikely that every loan in our portfolio would stop paying, but that could affect cash flow, right? If we have high defaults, we would have to start foreclosing. So cash flow could be interrupted. Now, I don't think you're at risk of losing a bunch of capital. We don't typically lend more than 70% of the value, but if we're relying on these people making their payments to pay our investors, and these investors are relying on that cash flow, that could be disrupted. So I think just, I'm trying to put my investor hat on and not be, a fund manager operator. I think having those conversations like, hey, can I lose my money? What would happen if the market shifted? What is the true risk in this? Those are things that I would also empower investors to ask an operator.
That's a great point, Heather. And that's a critical component when I'm working with people on any deal, any investment is, we want to know what could go right. And, odds are that your investment is going to play out as it's designed. But we want to know all different scenarios, right? Because it's important that you're comfortable putting your dollars to work, right? And you're in the 1% of investors if you know all the risks associated. And I really push our clients to get there, and they do. And that's why they're not very anxious, right? Because once you understand the education, it makes you feel a lot more confident as a passive investor. And I'll even go a step farther too, to say there's significant risk to just hoarding money in a checking account because of the silent wealth killer called inflation, right? So the purchasing power of those dollars gets eroded every single year. I was just at Chipotle last week and I got my burrito bowl and it was like $19, right? Whereas a few years ago it was 10, and that is just true across all asset classes, or is across all like consumer markets, right? Things get more expensive. And so there's risk just having money in cash. So it's really important to figure out what your risk tolerance is, understand the pros and cons of any investment, whether it's a stock, whether it's a private deal, a lending deal, or just cash, right? And then, find the appropriate team to kind of help you navigate those questions.
Hey, Kade, we can't hear you.
Kade, I couldn't hear you that last question.
I was muted. I said, where does the Chipotle bowl land on the inflation index? Is that because I look at fast food all the time? I mean, I remember the dollar menu, and then that's gone away. But I think that's an important metric, like what is your dollar really worth sitting there? I mean, is it secure or is it losing value consistently over time? And what does that look like for you to actually cash out of even a savings account at some local banks? Sometimes you got to give a 3-day notice to pull out over $10,000 in cash. So I couldn't agree with you more there, Craig. But I think we've touched a lot on the funds, and we get quite a bit of clients that we have conversations with about promissory notes, where we're talking about the operator. Obviously, the operator plays a role into that, but it's an individual investment. So for investors, or you, Craig, I know you funded some notes considering promissory notes. What's the most important thing, if you were shouting it from the rooftops, that people who want to invest in promissory notes should understand the most important thing?
Well, first of all, it's my favorite alternative investment right now. It shifts, right? When I was younger in my career, I would say physical real estate was my favorite for a variety of reasons. And now I'm kind of shifting my own portfolio more towards passive plays. I love investing in individual notes for a variety of reasons, but I'd say number one is you have capital protection, right? Because you're in first lien position on the deals that you do, right? So that's a really critical component. Another question I want everyone to ask themselves is, when you invest in a deal, right, or any investment, how do you get your capital back? And then how is my capital protected, right? So if the fund blows up, do I get my $50,000 investment back? It's important to realize where you are in the capital stack, as Heather alluded to earlier. One of the things I love about lending on individual deals or individual property is that you have that house as collateral, right? And then I know it's very unlikely that you'll have to go into a foreclosure process, but it does happen. It's a real risk that you need to be prepared. And one of the things that your team does so well is that you kind of hold the investor's hand, right, to help them deal with that process. And that's what people want, right? They want a partner and an expert to help them when things go wrong. But I'd say that the biggest, number one criteria for me is principal protection and being in that first lien position, right? There's subsequent questions you need to figure out: debt to equity, who you're lending money to, their history, their credit, their credit scores, how much experience they have. And that's something that your team obviously does a great job of helping investors dig through. But principal protection, consistent cash flow are my two big wins when it comes to lending on individual property.
Heather, I couldn't agree more, Craig. But I'll get to Heather in just a second. Some of the cash flow is obviously the big thing, and then yes, the house is secured, as you mentioned. The loan to value is equally as important. One thing I've kind of started talking a lot more with clients about is also understanding loan to cost. The valuations change. Markets change. What does that look like? But loan to cost is what does this guy have in this deal? What does that look like for you as when you're purchasing that loan? I mean, if the market tanks in that area in the term of, our loans are short term, but a 12-month value could change, rates could go back up, and who knows what that would do to the value. But what that looks like as far as an operator is asking what loan to cost means, and then what that provides to you as a investment purchaser. What that means is, that true loan to cost. So Heather, on that note, I asked Craig, what he would tell everybody and shout it as a purchaser, but as an operator, what would you want, one thing you would want investors to have a full understanding of or really understand before they started purchasing promissory notes?
Yeah, I mean, everything you guys have already mentioned is super important. But you can do this one of a few ways, right? You can get with an operator like us who does the underwriting, processes the loan, orders the evaluation, confirms that there's clear title. Or you can try to do it yourself. And there's no right or wrong or, one size fits all for everybody. Some clients are really hands-on, and Kade, this, they're very savvy. But the biggest challenge that I think investors that do it on their own have is deal flow, right? They a lot of times don't have enough deals to keep their money deployed. They're kind of doing this on the side. They have a full-time job. So the benefit to, buying notes from somebody like us is we have a much broader reach, right? We're originating hundreds of notes at a time. But I think title is really important. I just had a deal come to me, a local deal. I buy notes here and there, and this lady swore up and down she owned this property free and clear. She was ready to go. I pulled title, and there was a $300,000 loan on it that she swears wasn't hers. And it's like, maybe it was, maybe it wasn't, but it's on title. And you hear this all the time. I've had clients over the years. I went to a real estate investment meeting, and this guy promised me 15% returns, and I didn't pull title. And come to find out they were in a third or fourth position with no recorded mortgage. So I think doing your due diligence up front, making sure you're in a first lien with clear title, but then also once you do fund the deal, making sure that the deed of trust or mortgage gets recorded. Or if you're buying an existing lien, you need to have an assignment of mortgage recorded in your name. Because the reality is, if your name is not on title, you cannot foreclose on them. I mean, it's an unsecured note at that point. So I think it's, I think it's two-pronged. Up front, you need to be doing your due diligence on that deal. Who is the borrower? What is the property's condition? Also, another big mistake, not finding out what the property looks like inside. I've seen some properties that look real pretty from the curb, and people will fund a deal and they get it back and they look inside and the whole thing's gutted. I mean, these things happen. And then just being really mindful of fraud. I mean, there is just so much fraud out there with borrowers and, trying to borrow on properties. You wouldn't believe the horror stories, properties they don't even own, or, they have 5 other loans on it. So I think just really, pulling those title reports, making sure that it's being closed properly and your name's on title is another big component of buying notes.
She actually said a $300,000 loan wasn't hers. I mean, that's pretty. I see that a lot in cop shows when they're like, "Was this yours?" And they're like, "No, this isn't mine. I swear, but it was in."
Well, she claimed she paid it off. She didn't say it wasn't hers. She said it was paid off, And, unfortunately it was on title. So there's nothing, if it is truly paid off, then get it released or reconveyed, which she never was able to do. So I was very
It's not mine, I
suspicious.
swear.
Yeah.
It's not
I
mine,
think
somebody
funding
else's, don't worry. I can still close the deal.
funding promissory notes is a lot more hands-on than putting money in a fund, in my opinion.
Agreed.
So, Heather, you mentioned, yeah, it's a full-time job, and I have investors who are on this call that treat it like that. The due diligence package we provide is, a minimum of usually 200 pages of reports, background checks, valuations, settlements, your our original loan documents. But Heather, you mentioned something in what you just said about that I kind of want to touch on about lien position. Can you kind of speak on what lien position is and why it matters that investors know what lien position it is, and what is this first lien for people who don't know what that compares to if you're in the second lien or even the third liener position, why that matters as an investor?
Yeah, no, I think that's important to point out. So lien position is just your priority of your lien that is recorded against the property. So for example, a lot of people will take out a home mortgage with their bank, right, to buy a house. And then you may go get what's called a HELOC or a second lien. And really what that means is if you're in anything other than a first lien, in order for you as a lender to enforce your legal right to foreclose if that borrower is not making their payments, if you are in anything other than a first, you would have to be prepared to buy out any liens in front of you. You could not just foreclose. That first lien holder that would be in front of you, hypothetically, could foreclose and completely wipe out your lien and you would get nothing. It doesn't mean that you shouldn't do them. I know a lot of people that make a lot of money buying second liens. They're usually higher returns on them, but you just need to understand what's in front of you. I have some lenders that they'll buy seconds, and if that first lien goes into default, they'll just buy out the first and pay that first lien holder off, and then they can foreclose. But it really is just identifying where you are in priority as far as being able to enforce on a defaulted note.
That it's just important kind of to mention, because there is, in the, today's day and age, there's a lot of space about investing in different notes, and that's in different styles, defaulted notes, non-performing, first liens, second liens, and it's kind of an important identifying mark on where you are if, something does go bad and what that looks like. That's the worst case scenario, right? We're taking back this property. We're going through foreclosures. So Craig, what would you ask or tell people to ask when, investors are purchasing this note from an operator like us, for example, that's sold as a performing note? We only sell, performing notes at par. We don't have, the other types of deals for purchase. What should they ask, since the loan is newly originated, about, servicing, default management in a worst case scenario for their capital realistically, what that looks like from the partnership with the person they're purchasing the note from?
Yeah, I'd say the first question is to get comfortable around the return, right? So when you're lending your money to a borrower, understand why you're getting paid the rate that you are, right? And so I often recommend for first-time investors, say they're working with you and your team, Kade, it might be smart to wait, exercise a little patience and wait for a deal that is going to be, originated with one of your borrowers who's done a lot of deals with you guys and who's never missed an interest payment, right? And so that person usually has a lot of experience. You can look through the due diligence package. You can check, all the deals they've done. You can look at their credit score. And because they're very solid on the borrowing side, right? So risk is low. That typically means your return, right, or the rate that you're going to charge them is going to be a little bit lower, right? So you're accepting less yield on the deal with a higher likelihood that you have a good experience and nothing goes wrong, right? And so when you have, if you see, a higher rate, right? It's like, oh, there's, to Heather's point earlier, chasing yield, right? There's probably a reason why the loan is going to be a little bit more expensive for the borrower. So I think, as you first start out, it's good just to get the experience down, right? And what's really cool about this type of investing is not only are you making money, but you're also giving yourself an education, right? When you go through the process once, you learn all the terminology, you understand, loan to cost and loan to equity, like those terms now that seem kind of, out there in space, they become real, and you actually put pen to paper and you say, okay, this makes sense. And then you as an investor, that's how you get better, right? That's how you gain experience. And, that's how, if you want to do some more risky deals where you're not in first team position, you can make some more money. That's how that happens, right? But you gotta swim first, right? Before you can
Right.
jump in the deep end. So I think, just start conservatively, ask the questions, like, why does this make sense from a yield perspective? And then lean on you, Kade, in terms of, what opportunities are out there to fit a risk appetite.
Heather, did you want to add on that? We're kind of getting close to the top of the hour, and I have some fun questions I want to run through with you guys that I made up.
Yeah, the only
through my
thing I would add to the due diligence on the promissory note is, obviously you want to do your due diligence on the borrower as well as the subject property that is, ultimately securing your investment. But I also get a lot of people that didn't think about how they're going to collect on the payments. They'll buy a note and then they find out after the fact. I think we actually have a client like this, Bruce, that bought a note and then didn't realize he had to go find somewhere to service it. And so I'm not saying that our model is perfect, although I think it's pretty good. I mean, we provide, what did he say? A very concierge service as far as servicing goes, because we want that note to perform. We don't want to just originate as an operator, sell it off and wish you luck, right? We benefit when we sell it. We do retain an interest strip on it, which means we still have some skin in it. You own the note wholly, but we want that borrower to make their payments. And so we service everything internally. If there's rehab involved, how is that going to be managed? You better understand that right up front. We actually do that internally at Central Lending to make sure people are getting their projects done. If you're buying any notes that are what we would consider a ARV, after repair value loan. And then the other big thing that I've said this for years is, what's these people's skin in it? Are you buying a note that's 100% funding that this borrower he has nothing to lose if he doesn't make his payments, right? He washes his hands and he walks away from it. I like skin in the game. I like money down, or if it's a refinance, I want to know how long they've owned the property. Did he just inherit it from Aunt Sally and now he's pulling a bunch of cash out? That would be a big red flag for me. So really know what that borrower's skin in it, because I've been in the private lending space over 20 years, and I will tell you, the deals that go sideways are the people that have nothing to lose in it. And it just, they just are not motivated to find a solution when they have challenges.
Why are they willing to pay this high interest rate that you might be looking at? What does that look like for them as a investor? Because the borrower is also, on our deals, they're an investor themselves. So common question I always get asked is, why is somebody willing to pay these high rates? It's like, well, we fund quick, we close the transaction, we'll fund the rehab, and they can exit. And usually there's enough equity in the deal, because we have a max of 70% loan to value, that they can then take that, and their profit is even greater than that on top of it. So why is the borrower willing to pay it? Put yourself in their shoes. They are investors as well. They're looking to make a profit out of this. And if they're willing to pay those higher rates, that should trigger some flags. It doesn't mean it's, an instant stop, that the deal's not there. I'm not saying that, but it should definitely trigger some flags. And it's something to consider as a somebody looking at purchasing these individual deals, like you said, is this guy just inheriting this house from somebody who bought it, in the 50s, and there's a ton of equity, he's pulling a ton of cash out, never done a deal before, and he's gonna he's gonna go buy a nice boat, or what does that look like for them? Are they funding the rehab with it? Those sorts of things are very important questions, as you mentioned. Okay, we're kind of at the top of the hour here, but I emailed about 3 or 4 of our kind of, I don't want to say brash, but our fun, blunt investors that'll give it to us straight. That I asked for 3 questions that they would want to ask, and I took a mix of them. So Heather, don't look nervous. It's okay.
I'm nervous.
So this one is obviously, we're not giving financial advice, as we've exclaimed that multiple times, but this is a good question. I kind of wanted to mention it, and it's kind of just personal opinion. Before the other stuff, is what is, in the recent years, what are the worst pieces of financial information that you've overheard somebody tell somebody else, or at a dinner party, networking event? Don't have to name names, just what was the worst thing you've heard that scared you to a point? And thank you, Richard, for this question. Start with you, Heather.
Is that so what is the worst? That's a tough one. Gosh, there's so much out there.
To give you an idea and let you think about it, he answered me, and it was, he had overheard a friend of him saying that he should put it in a bank CD because banks can't go bad.
Oh.
Just stuff like that. It was loose. Craig, do you think of anyone off the top of your head?
Oh gosh, be very careful with leveraging a stock market portfolio. Right. So this is our old friend, the margin call. It's why I like using leverage on real estate, because real estate's not mark to market daily. Right. So if you take a loan against a stock portfolio, right, especially one that's highly volatile, if those stocks take a dive without even letting you know, maybe you'll get an email, the brokerage will start to liquidate your positions to cover the short. So be really, really careful with leverage. I've seen some people take some crazy risks on that side of the house, where just, I feel like I have a pretty big risk appetite, but some of those stories I've heard make my stomach turn.
I will dovetail off that. I have had some clients that are at an age where they're retired, or they've, exited a business, but then they've also gone and leveraged like a HELOC, which I'm not saying is always a bad strategy, but I've heard of them doing it with adjustable rates, and well, I'm relying on getting paid from this investment to cover that. I think that's really risky. It would make me not sleep at night. Totally not my decision to make. I don't give financial advice, but that is one thing that if you are needing those investment dollars to cover other debt, that is a bit concerning to me. And I think you mentioned it, Craig, what somebody that's maybe 30 years old has as far as a risk tolerance would be very different from someone who's maybe in their early 60s and retired and living on a fixed income. So those kind of conversations make me very nervous. And I've turned people away and said, this is not the right investment for you. I don't want to be responsible for that if, something doesn't perform. And especially like notes. Notes are a perfect example. Obviously you need to do your due diligence and feel pretty confident that this borrower is going to perform on the loan, but the risk is they might not pay. And then you don't have income coming in. You've got foreclosure costs. You're probably going to have to pay taxes and insurance. So I think that can get people into some trouble too as well. And not diversifying, don't put all your eggs into one basket. That's another big issue is, they start trusting an operator and they just dump all their capital into it. That operator goes sideways and now they have nothing performing. So I think diversification is really important as well.
And then I'll pull it back to MySpace for the last question, then we'll wrap this thing up. I want to hear from both of you. What was your very first alternative investment, and how quickly did you realize you had no idea what you were doing? Or did you realize what you were doing?
You
I
can
love
go
it.
first, Craig.
Personally, not
Sure.
let it live. Go
Yeah.
ahead, Craig. Personal. This is portfolio yourself.
Mine was a single family home that I purchased, and was super nervous. I actually still own it, and it's done phenomenally well. From a market perspective, it was a Section 8 house. And I took the guy that I bought it from. I took his advice and did not hire a property manager for this one, even though it was out of state. And so what I did is I found a local handyman that I was very nice to financially, and he became my de facto repair guy. Right, so I established a great relationship with him. The Section 8 payments have worked out well. I know the tenant, and I'm actually looking to do a nice big cash out refi on this guy. I love cash out refis because you don't pay taxes on those loans, and I'm going to deploy that capital elsewhere. So that was my first one. It was I was nervous, but you got to start somewhere, right?
Exactly.
That's a good
Craig
one.
hit it out of the park on his first try. Look at that. Good job.
They're not all home runs, though, Kate. That one luckily turned out to be a fun one.
I appreciate that. Heather.
Mine would also be a piece of mine was a piece of real estate, our first fix and flip. And I think the biggest mistake we made is we thought we could do everything, to the point of installing cabinets ourselves, laying tile, painting. And because we did everything ourselves, it took much longer than we thought. Our holding costs were out of the roof. The house we bought had a hole in the dining room roof that had been there for 3 or 4 years. So it had been raining and snowing over the seasons. So there was mold.
That's a skylight.
But it was a beautiful skylight, lots of fresh air. And we got out whole. We didn't make a lot of money, but we learned a lot. I learned that other people can do things a lot quicker and faster than I can. So, it's a cost of doing business. But yeah, we were convinced we were Chip and Joanna, and it was not as glamorous as it looks on TV, let me tell you.
Oh man, that's awesome. I think those questions are always fun to close it out because it's personal. But Craig, man, I can't thank you enough, man. This was a lot of fun. I think this style it's more our niche. It was a lot of fun having you on. I really appreciate you coming on.
Thanks for having me, guys. Yeah, you're a natural, Kate.
I know. I got to get like an MC.
Yeah, we appreciate you, Craig.
Feelings mutual.
And everybody, thank you guys for joining us. If you are an investor of ours, we are having a summit in Lakeland, Florida. If you want to come meet the operators, discuss with us, kind of pull back behind the curtain. We are inviting a very select few people who register. So if you're interested in that, I'm going to pop that up on the screen really quick, and you can register. We would love to see you meet you. Craig, I don't know if you're going or Chris is going.
I'll be there. I think we'll both be there.
Craig will be there. Hear that, everybody? So you got to register now. But we
seats are limited.
Go ahead, Heather. The delay is tough. It's throwing me off.
Oh, I just said seats are limited, so sign up.
You guys can sign that QR code in the corner. It'll be up, and it'll also be included in this replay we're going to send out if you weren't able to join live. We would love to have you there and love you have you there in attendance. Shannon, I will reach out to you directly. I just saw your comment. We really appreciate you guys joining again. Craig, thanks for coming on and chatting with us, and we'll see you on next time. If anybody here is on our email list that wants to be registered to our next webinar, Heather and I are going to do this monthly. In the email that'll send out with the replay, just opt into that so that you're automatically registered and getting our replays going out of this podcast style webinar thing we're doing.
Thanks, Kate. Thanks, Heather.
Thank you, guys.
Thanks, Craig. Thanks, Kade.
Bye. Thanks, Edward. We look forward to having you. And again, guys, if you want to join up really quick and connect with Heather or myself, you can go ahead and scan this on the QR code on the screen right now. There's two of them. The bigger one is you can connect with Heather. go through a meeting with us. And the one in the corner is to register for our summit. If you do register for the summit, a team member will reach out to you directly and kind of confirm some details. Like we said, seats are limited, but we thank you guys for joining us, and we'll see you on the next one.